Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
Welcome to the only show in the country dedicated to helping savers worry less about money, the WorryFree Retirement, with your host, the author of 4 books on retirement and offices in Bowling Green and Louisville, Kentucky, the money missionary himself, Tony Walker.
Welcome to the WorryFree Retirement, and I am Tony Walker, your host for the next 28 minutes or so, and we're glad to have you along. Normally I just jump right into the essence of today's program, but I'm actually going to start today's program with a question. And I get questions all the time. In fact, over the years, literally hundreds upon hundreds of questions, all the way back when I used to do the Wave 3 Listens Live show. And, I had call-in questions. Of course, we still get them. But here's one, for instance, from Charles. He's in Bowling Green. He said, Tony, I have a modest amount in both my 401k and Roth IRA accounts. Presently, there are no contributions being made to them. The problem is that fees are eating up much of what they're earning. Are there options available to help with this situation? Thank you in advance, Charles. Now, what's interesting about this question, the reason I start off the show with this question is for some reason, at least over the last 20 or 30 years, I guess ever since 1978 when 401ks were first invented, everybody seems to think, just like Charles, that there's only 2 options. You either put your money in a qualified account like a 401k or IRA, TSA, that'd be pre-tax, or you put your money in an after-tax, tax-free conduit, such as a Roth IRA. And as Charles admits here, he's pretty studious, of course, I think he's frustrated because he's not going anywhere. In his particular situation, probably for various reasons, but the fees in particular are eating away at his returns. Incidentally, before we get into today's show, we're not going to talk about our new platform with Charles Schwab, which again, they just serve as our custodian, but I'm very, very excited about the growth of this program. We just started this program in April, okay? Now keep in mind, I used Charles Schwab as my custodian when I managed money in the 90s. We'd been putting money with another company over the years, but from about a 4-month period of time when we opened up this new platform with Charles Schwab as our custodian, we're already over $30 million under management that quickly. And I think the reason is not only is yours truly overseeing this as a fiduciary, but our fees are so much lower than other managed platforms. In fact, I talked with a client the other day that's moving their money over, and they'd been to a dinner seminar and they talked to the people, and the people said, well, we charge 1.5%. I don't think that's all the fees, quite frankly, that's just their fee. And the person said, well, that seems pretty high. And they said, yeah, but we're able to basically tell you when and not to get into the market. In other words, I guess these people feel like they can time the market, which I think we've proved over the years, folks, that's an impossibility. So again, if you have any interest, if you have money languishing in the bank, you've got a 401k, IRA, obviously we're going to talk about another subject today, but if you want to see this Charles Schwab platform that we have created with Charles Schwab as our custodian, there's absolutely no cost or obligation. We'll be able to do a free fee analysis for you. All you got to do is email Heather at TonyWalkerFinancial.com, Heather at TonyWalkerFinancial.com, and I think you'll find in some cases we can save people thousands of dollars per year. That's not just one time. In some cases, again, we've proved we can do this. Plus, we would be there to monitor and do everything for you. I think it's a heck of a deal. All right. So anyway, are there other options other than Charles's 2 thoughts of 401ks and Roths? Well, today, I hope to convince you that after my personal 33 years in the field of finance, following personal studies from some of the greatest minds in the business, along with meeting literally with thousands of people over the course of my career, why the subject of life insurance, the product of life insurance, listen closely, is, I believe, one of the greatest financial tools. However it's misunderstood, doesn't matter. The facts are, it is one of the greatest financial tools ever created. Now, we're talking about permanent life insurance. We're not talking about term life. But before we dive into this and why it's so good, we've got to harken back to the last episode or so we did when we explored the notion of needs versus wants. Incidentally, Aaron, who's producing the show today, Aaron, if they go on the YouTube channel, could they find that particular show? Yes or no? By then, the two should be. But you can go to our YouTube channel at Tony Walker Financial. Should be able to find that show. It's a very interesting show about needs versus wants, which we're going to summarize that a little bit. So basically, a few weeks ago, I shared this notion that the financial world loves telling you what you need, while all along we must admit that we already know what we need. Again, regardless of whether you're rich or poor, all we really need is food, clothing, and shelter. That's about it. That's all we need. However, if food, clothing, and shelter is all we need, how come we worry so much about taking our hard-earned money and trying to get things we want? Remember, as an advisor, in order for me to truly understand what you need, I got to understand and explore what it is you really want. Those are the real key questions for a trained advisor, because even though we have the same needs, we tend to have different wants. That's just a fact. If we didn't, let's face it, we'd all drive the same cars, we'd all live in the same modest homes, we'd all head over to Goodwill to get our clothes, we would never eat out, we'd slave away and have our vegetable and fruit garden. So you see what I'm saying? We don't live in a commune, folks. This is a democracy, and we all have different needs and wants. We're humans, and that's just the way it is. So the theme of last week's show, or 2 weeks ago, whenever we had the guest on, whose husband passed away. Hopefully you saw that episode. Very moving and telling episode of what we're going to talk about today. But basically, this particular individual, when her husband passed away, thankfully, he had plenty of life insurance, which allowed her at his death, she was in her mid-50s at the time, to pursue something she always wanted to do. Again, wanted to do, didn't need to do because she couldn't afford to do it. She wanted to write. So let's go back to that interview with the young lady, again at 55, in the middle of her career. She loses her husband to cancer. And again, you can see the interview here as we're rolling it. But again, thankfully, her husband had a substantial amount of life insurance so that she could pursue the things she wanted to do following his death. Now you might say, well, Tony, did they not have a 401k? Yes, he did. What about her? Doesn't she have a 401k? Yes, she did. Why wouldn't she just quit work and use that? And that's what we're going to talk about. Because the problem is with those 401ks being under 59 and a half, plus if she were to just liquidate those and try to use them, the tax tumor would have eaten her lunch, not to mention the fees that continued on with the 401ks. So it really is a big lie that you're hearing from the financial world when people tell you you will not need life insurance in retirement. Now stop to think about this, especially if we're getting ready to discuss this segment in more detail. The question is not how much life insurance do you need? That's an impossible question to answer. But rather what it is you want out of the money that you have. And assuming you could get life insurance, let's pose this question. Let's just assume, Aaron, you could get as much life insurance as you could get, and there was no out-of-pocket cost to get that life insurance. How much would you want? Aaron said a lot. You might be saying, I'd get as much as I could, Tony, if it's free. It's kind of like the Jim Gaffigan skit he does on free bread. It's hilarious. You ought to check it out. He goes to a restaurant and they bring out the bread. He goes, wait a minute, the bread's free? We'll just have free bread. Forget the meal. But anyway, again, yeah, if life insurance were free, you wouldn't say, well, how much do I need? You'd say, how much can I get? So it's not the idea of what you need. Life insurance satisfies that deep down desire to provide for you and your loved ones in terms of what you want. That's the whole purpose of money, is to use this money to the best of our ability, and then hopefully, in the perfect world, we get to pass it on to our families when we die. The problem with 401ks and all these other things, many of them, they pose problems when we die because of the tax tumor. As we're going to see in our next segment, life insurance is the most seamless, most tax-free asset, most perfect asset, actually, you can pass to your loved ones at death. So again, the reason a lot of the pundits on radio and TV don't understand life insurance, and they're always talking about buying cheap life insurance like term, is because they really don't understand planning, and they don't know how to figure out a way to help you get permanent life insurance at the least amount of cost, because that's what really everybody wants. So when we return, what I'm going to do, I'm going to go to the whiteboard. I'm going to explain the proper use of permanent life insurance. And yes, we're also going to dive into these recent Department of Labor rules that have been imposed on the financial community And you're probably seeing a trend all of a sudden. You might be saying, Tony, I know you're talking about life insurance. Everybody else is all of a sudden. Why is that? Well, we're going to find out why this Department of Labor ruling, in my opinion, is forcing advisors to run around and start talking about you throwing gobs of money into life insurance all the time. All the while, I don't think many of them understand the potential problem they're creating by something we call single premium life insurance. Folks, this is good stuff. And if you would admit this morning or this afternoon, whenever you're watching this show, that, yeah, I think I'm going to die one day, Tony, you probably ought to stay tuned for this because life insurance is going to fit that bill. You're watching the WorryFree Retirement. I'll be right back after I get out the whiteboard.
Are you worried about going broke in retirement and being a burden to your children? Plan on attending Tony Walker's next free workshop, Retirement 101, Tuesday, August 15th in Bowling Green and Monday, August 21st in Louisville. During Tony's workshop, you'll learn how to lower taxes and fees on your money and how to secure mailbox money for life. That's Retirement 101 with Tony Walker, Tuesday, August 15th in Bowling Green and Monday, August 21st in Louisville. Seating is limited, so register today at TonyWalkerFinancial.com.
Call me old-fashioned, but I love the fact that my husband takes care of all the finances. But if something happened to him, where would I turn?
Whether you're divorced, widowed, or single all your life, don't go it alone. Attend my next free financial forum exclusively for single females. There's 2 times to choose from and seating is very limited. Bring a guest and log on now to TonyWalkerFinancial.com and I'll see you then. Welcome back to the Worry-Free Retirement. I'm just kind of glancing through Ed Slott. Ed Slott's a pretty well-known CPA who, incidentally, I studied under Ed Slott. I was in his first ever Elite IRA Advisor program. Go down there and study. He's a great individual, but great book you might want to pick up. How to Parlay Your IRA into a Family Fortune. And in this, for instance, on page 48, it talks about, listen to this, Mr. Slott feels that the best source of post-death cash, let's just put this up full screen here in this quote, the best and most effective way to provide money to cover estate taxes and other post-death expenses when there are few other liquid assets in the estate is through gifting and life insurance. Now, Mr. Slott is just mentioning one aspect of how to use life insurance. The point is that life insurance, it's what I like to say is tax-free, cold, hard cash. Now, what do I mean by that? Well, let's go back to our example that we had in the first segment. You have a 401k or IRA, and all of a sudden you pass away, and your spouse needs that money for some reason, or your children need that money. Well, the person standing there in front of them is not your kids, it's the IRS, because they're going to want their money. There is a tax tumor built within that. Plus, if you try to leave an IRA or 401k to a child, even if you try to leave it in trust, a lot of people try to do this. It gets very, very complicated to do that because if you leave the IRA to a trust, the trust has its own tax bracket. You could create all kinds of problems with these minimum distribution rules that follow that IRA to the next generation. So I always like to say a 401k or IRA is a great savings tool. It's a lousy tool to leave to other people. Whereas the life insurance, if you use it properly, it's a great savings tool. It can be used properly during your lifetime. I'll tell you an example I've got with mine. And then finally, ultimately, when you die, not if you die, when you die, you can leave cold, hard, tax-free cash to your loved ones. Not a bad deal. And I don't know why people have a problem with that. It's strange. Anyway, so earlier I mentioned this whole Department of Labor thing, which again, in its essence, you've probably heard it. If you've got an advisor, I know you've heard about it because they're all wishy-washy. Everybody's changing up what to do. Nobody knows what to do. The Department of Labor just kind of threw this fiduciary rule in, which we've been a fiduciary for years, and it was supposed to be pretty simple, but now it's gotten very complicated. And I'm having a lot of my clients come to me and say, Tony, out of the blue, I'm having people approach me about life insurance and especially putting in large sums of life insurance. That's called a single premium deposit, which on the surface, there's nothing wrong with a single premium deposit. That's where you just dump a bunch of money in the policy. And we do some of those, but you have to be very careful. So what I want to do is, what I'm trying to teach you today is don't take one of the greatest products ever created and unintentionally take away some of the tax advantages. So let's turn to the whiteboard here. And again, Remember, we're talking about life insurance, and let's just forget the name life insurance. The next time somebody says you don't need life insurance in retirement, answer them this way. Why wouldn't I want tax-free cold hard cash to be left to my family? And most people would say, that's a pretty good question. Remember, it's not the problem with the life insurance, it's paying for it. And that's where we can show you how to find the money within your planning, whether it's through savings and fees, taxes, all these things that you're wasting money on. Why wouldn't you take some of that money, maybe you're giving to Wall Street, for instance, why wouldn't you put it towards your family? That's the kind of stuff we like to do. All right, so what we're talking about is a MEC, that stands for Modified Endowment Contract, versus a non-MEC. Now, why am I covering this? Because a lot of people, I had one of my clients the other day went to a seminar and she said, Tony, they were talking about us putting in large sums of money into this contract, a life insurance policy, and if we put in, $500,000 up front, we would have $3 million for our family. And the first question I said is, that's a lot of money. You sure you want to put $500,000 in there? Why wouldn't you just pay that over time? Because if you put the $500,000 in, it'll become a MEC. And they thought, well, they didn't say anything about that. What's a MEC? So let's make sure you understand what a modified endowment contract is. So let's just say, for instance, you want a $1 million policy. And again, these are just conceptual numbers. Life insurance is based on age and all kinds of factors. So don't think your premium would be this, okay? We're just talking about concept. And on the one hand, you could go to an insurance company and they say, well, sure, if you'll give us a one-time payment of $300,000, you'll owe no more premiums. Just do it one time, give us $300,000, and you'll get the $1 million policy. Or the other company says, if you'll give us $20,000 each and every year, okay, then it will be a non-MEC. Remember, non-MEC, well, you don't say remember because most of you don't know this. Let me kind of go back. In the 80s, this came about because a lot of firms were dumping large amounts of money into these policies because they wanted the tax-free loans. The government came in and said, you can't do that anymore. And that's where this whole modified endowment rule, it keeps you from putting in too much money and taking advantage of the taxes and the advantages that afforded in life insurance. That's why all this came up. So in a MEC, if you put too much money in, so basically you fall under an accounting method in MEC called LIFO, last in, first out. What that means is a life insurance policy, the cash values grow tax deferred, a huge advantage. But if you've put in too much money and you exceed those limits by law, if you start taking money out of that, the last in, first out, that means the last in would be the interest, you're going to have to pay taxes on it. Whereas under a non-MEC, it's FIFO, first in, first out. So you've put in the money after tax. If I want it back out under FIFO, it's very advantageous to me because I can take the first money out without taxes. So you lose the FIFO accounting method. 59.5, if you have a MEC, if you take out money prior to 59.5, you have a 10% excise penalty, just like an IRA, no penalty here prior to 59.5. So I'm under 59.5. I have a large permanent dividend participating whole life policy. I borrowed a large amount of money from it to help my son, my oldest boy, buy his first home. I'm the banker on it. He pays me the mortgage payment. It saved him a ton of money, but I had no taxes to make the loan. You see what I'm saying? If I had done a single premium policy and borrowed that money, I would have had a 10% excise tax penalty, plus potentially the loan, this is awful here, could have been fully taxable, whereas a loan on a non-MEC is tax-free. Folks, I hope you're seeing this. And this is why before you go rushing out throwing tons of money into life insurance, be very, very careful that you're not taking away some of these advantages that already exist. This is what you have to be careful of. Now, granted, yes, with either one of these at death, all right, the death benefit is still tax-free. So whether you have a MEC or a non-MEC contract, at death, your beneficiaries will still get the money tax-free. So what's the point? What are we even talking about, Tony? Well, as we come over here and we think about what Ed Slott is talking about, let's take an example of a 401k. Okay, let's just say you've got a 401k and over time you've accumulated $500,000 in that thing. You have to think about it and you say, well, Tony, I've got plenty of money. This is what our person that we interviewed was talking about. She thought they had a lot of money. He had a 401k, she had a 401k. When she met with me and we went through all this and she talked about quitting work, I said, do you realize if you stop work because you're under 55 and a half, you're falling into these 10% excise tax penalties. You're going to have to pay taxes at ordinary rates. Now that you're single, you're going to be in a higher tax bracket. it's going to be a disaster. So in her case, okay, age 55, think about this. Almost 50% of this was going to have, almost, with the excise taxes, everything, almost 50% of it was going to go to the IRS in the form of taxes, which prohibited her from doing something. So let's just think about this a minute. If we've got assets out there that are for a retirement, the real question, and this is whether you know if you got a retirement specialist or somebody just peddling products or throwing out flippant financial advice on a radio program, how are you going to maximize and use that money now while you're alive at the least amount of taxes and least amount of fees? And then finally, when you die, not if you die, how could we possibly pass the same $500,000? Listen to me. The same $500,000, how could we pass that over to the family at your death tax-free? How could we do that? You might be saying, Tony, how could you do that? Well, I'm not going to share that secret sauce on the TV show. We've got to talk in person for me to show you how to do that because, quite frankly, everybody's situation is different. But let me propose this to you. Instead of just sitting around thinking you can't do anything, or sitting around thinking that you're just going to max out your 401k and hope all these taxes and fees go away, which they won't, why don't you take action and contact us today? Log on to TonyWalkerFinancial.com. All you got to do is click on that Meet with Tony button. I'll personally talk with you by phone or in person if a meeting warrants. We got offices conveniently located in Bowling Green and Louisville. We see hundreds of people throughout the year. And if you're that type of person that's a saver and you're worried about your money and you're thinking, Tony, I don't think anybody's looking out for me at all. It seems like all that's happening is people just taking more of my money in the way of fees and taxes. Log on now to TonyWalkerFinancial.com. Well, does the Bible have anything to say about this idea of what we leave when we die? It sure does. But before I get into this, I got to get me a cup of coffee. I'll be right back.
I want to retire. The problem is I don't have a game plan. And who do you trust? I guess I'll just have to go it alone.
Whether you're divorced, widowed, or single all your life, don't go it alone. Attend my next free financial forum exclusively for single females. There's 2 times to choose from and seating is very limited. Bring a guest and log on now to TonyWalkerFinancial.com and I'll see you then.
For years, you've seen him on TV. Now see him in person. As retirement specialist and fiduciary, Tony Walker personally hosts his next free workshop, Retirement 101, Tuesday, August 15th in Bowling Green and Monday, August 21st in Louisville. Learn how to set up mailbox money and leave your worries behind. Attend Tony's workshop Tuesday, August 15th in Bowling Green and Monday, August 21st in Louisville. Mailbox money can help you enjoy and protect your retirement. Seating is limited, so register now at TonyWalkerFinancial.com.
Dag nabbit, that's a good cup of coffee. You know, folks, I literally see hundreds of people a year. Now, when I say see people, I'm talking about sitting down in person, face to face, knees to nose, eyes to eyes, and all that good stuff. And all I do is sit down, and the first thing out of my mouth when I'm meeting a person for the first time is, tell me what it is you need, and I'll help you get what you want. So I talk about their dreams. I talk about their vision, not only for themselves, but here's the important part, especially if they're close to family or have children. What is it you want for your children now? And maybe, possibly even, what do you want for them when you die? And in all of that, everyone's different in terms of what they want to leave their children when they die. Some want to give adult children nothing more than a good education. They might say, that's my only responsibility. Past that, they're on their own. Nothing wrong with that answer. Some people, parents, feel that they want their children to enjoy their money now. They like to give them a lot of money now, as opposed to trying to stockpile money to leave them at their death. Then you have some parents who wish to do both. They want to give as much money as they can to their children now while they can watch their children enjoy it. And they'd also like to leave children money at death. Now, I'm kind of in that last camp. I've never had a lot of money. Finally, I've gotten to a point where I've got a little bit of money in my life. So I like to give money to my kids now. And then I have a lot of life insurance because I know, and as we're going to see, as we saw in the earlier segment then, that can leave them tax-free, cold, hard cash when I die. Because I do really fear that children, the adult children of today, millennials, X generation, they're not going to have any retirement, folks. I don't know where it's going to come from. I don't know who's going to pay off all this debt. So I'm going to do my best to leave them tax-free assets so I can try to help them. In Romans 14:22, Paul says, he says in 14:22, faith, the faith you have, basically he's saying keep it between you and the Lord. Yes, even on this topic that concerns whether you want to give money to your children now or when you die, Paul says in this verse, happy is he who does not condemn himself in what he believes. So what Paul is saying is, whatever you ultimately decide to do for your family, that's really between you and the Lord. So again, I'm not trying to be judgmental with this next verse because it might come off that way, all right? So let's turn over, Aaron, as we think about what the Bible has to say about providing for loved ones. Let's go over to 1 Timothy, if we will. 1 Timothy 5:8. It simply says, but if anyone does not provide for his own, look at this, and especially for those of his household, he has denied the faith and is worse than an unbeliever. Some versions even say an infidel. In other words, if you're a follower of Christ and you can't even take care of your own household, how in the world are you going to take care of others? And this is kind of stinging on me sometimes, and that's why I feel obligated, because I want to make sure my household's taken care of, because I also have a responsibility on how to help others take care of theirs. Does that make sense? I mean, if I'm going to help other people plan for their family's future, I've got to also, I can't be a hypocrite, I've got to also take care of my family's future. So again, not here to judge, but just to ask you a question. Do you have a plan in place? A plan in place that efficiently, as best you can, leaves money to your family when you die, not if you die, on a tax-free basis. So let me encourage you to think about that. Take heed of this particular scripture and don't put off doing tomorrow what you can do today. We are specialists in the area of how to plan for your future, not only while you're alive, but when you die. Folks, I've been doing life insurance and working in that field since 1985. I've seen about everything and I understand these products well. If you would like to see some information on just even how to lay out a game plan as it pertains to life insurance, how to take your 401k or IRA and how to, as Ed Slott said earlier, how to parlay that into a tax-free family fortune for your family, and also how to use and enjoy that money while you're alive, why don't you go to the website right now, TonyWalkerFinancial.com, click on that Meet with Tony button, and let's see if we can work out a game plan that allows you to have your cake and kind of eat it too, in terms of enjoying your money, but also how to leave money to your family on a tax-free basis when you die. Well, I hope you've enjoyed today's program. You've been watching the Worry-Free Retirement, and until next week, we'll be seeing each other, but in the meantime, if all else fails, don't forget, you be worry-free. Have a good day.
Thank you for watching the Worry-Free Retirement with Tony Walker. If you need a safe and simple game plan for your retirement, log on to TonyWalkerFinancial.com and schedule a free, no-obligation meeting with Tony.